When somebody comes to me and they want to buy a house, they're looking at getting a mortgage, first question they usually ask if they don't know anything about mortgages, what's your rate? And it's actually a super complicated question because there's a lot of factors that go into it. And believe it or not, you as a homeowner, as a home buyer, have a lot more choice in what interest rate you get than maybe you realize. So I put this together. Hopefully it'll be helpful information. And I just want you to know before I get into this that the rates that I'm showing you here and the scenario I'm showing you here is very generic. I'm just trying to illustrate how you have a choice in what interest rate you get, and I want to help you understand how that choice works. But don't get hung up on the actual rates I'm showing you or the down payment or anything like that. This is just, again, the only point I'm trying to show you here is that you really actually have more of a choice than maybe you realize. So anyways, take a look. Okay, and as I said a second ago, the interest rates I'm going to show you here are for illustration purposes only. They definitely may not be available to you, but this is just, I just want you to understand one concept. And also want to overemphasize here, this is an oversimplified explanation. So again, don't pay too close attention to the actual numbers I'm showing you. I want you to understand the concept by the time we get done with this video. But if you are looking at a specific loan scenario, talk to a licensed or NMLS registered mortgage loan originator. Okay, so the scenario I want to show you today is somebody who's buying a house for $300,000 and they're going to put 20% down. So that's going to be $60,000. And all other costs that are not related to the interest rate will come to $5,000. Again, these are just assumptions. And so this chart that you're seeing here is all available interest rates to this customer. And so before we get started, again, I'm going to repeat down payment of $60,000, other cost of $5,000, so a total of $65,000 of cash that they would need to bring to closing before we dive into this interest rate piece. What you are going to notice here is you'll notice the numbers turn from black to red. And what that is just kind of a breaking point where the interest rates go from costing an additional premium to actually paying a credit to the customer. All right, and so this is the lowest rate available on this particular day, 3.375. And so generally you would think, well, I want the lowest rate, don't I? Well, not necessarily. In this case, in order to get the lowest rate, you would have to pay a premium of $11,726. And the number over to the right, $1,061, would be the principal and interest payment. So if you chose this rate, you would actually tack another $11,000 to your bottom line of $65,000. If you chose the highest rate that's being offered today, that would actually give a credit of $3,300, which would lower the amount of cash you bring to closing. As you see, your payment goes up to $1,325 in that case. And so I'm going to look at those two, where the breaking point sort of occurs, where it goes from a cost of $645 to a credit of $333. And so let's say that you were kind of on the fence. You don't know which one of these would be best. You want the lower rate, and you want to know, which one should I pick? Well, what I'm going to look at here is a $979 difference in cost, right? So one actually gives a credit towards closing costs, and one actually adds to your closing costs. And in order to, if you selected the lower rate, you would save $17 on your monthly payment. So what I'm going to do is take the difference in cost divided by the difference in payment, and that's going to come to about 55. So what that is 55 months, or about 4.5 years, that it would take for the lower interest rate to pay for itself. And so here I want to now compare the lowest rate, 3.375, to kind of that middle of the road rate of 4.5. And so same math right here. If you take the difference between $11,726 and $333 as a credit, it actually comes out to $12,060. Divide by the difference in payment, $155, and that comes to $77. So in about 6.5 years, the lower interest rate would have paid for itself. And now I'm going to go the other way, compare the middle of the road 4.5 to the highest rate, 5.25. Same exact math. It's $29.66 difference in price divided by $109 difference in payment comes to 27 months, or just about a little over 2 years that it would take for the lower rate to pay for itself. So again, I've only showed you 3 scenarios just to keep it simple. I'm not going to go through every rate there. But what you can see is if you chose the lowest rate of 3.375, your cash to close in this scenario would be $76,726. Your middle of the road 4.5 would bring your cash to close down to $64,667, and your highest rate would be $61,700. So how do you know which one you should choose? And there's really 2 questions you need to be asking yourself. First is, how long do you think you're going to be keeping this mortgage? So is this kind of just a short-term mortgage? You're probably going to refinance in another year or 2 for whatever reason. Do you think that maybe you're going to be selling the home and moving out of state or whatever in the next couple of years? If that's the case, you're probably going to want to lean towards maybe a higher interest rate. And then the other question that you want to ask yourself is, what's more important to you today? So if you really don't have a ton of cash in the bank and you want to keep as much of it as you can for maybe your furnace is going to go out or whatever, if that's the case, you probably might, again, lean towards the higher interest rate and keep a little bit more of that cash in your pocket. And so, of course, this is a little bit of a complicated topic. I hope that you found this information helpful, but if there's anything I didn't answer, go ahead and leave a question in the comments below.